Hello students, in our today's cash flow statement lecture, we are going to solve the illustration number 12. The balance sheet of the Kundan Limited is on 31st March 11 and 31st March 12 are as follows. Liability and asset side is given. Additional information. Investment are sold at a profit of rupees 20% on sales proceed. The depreciation return of 30,000 and 20,000 land and building and machinery respectively. Then the company has redeemed a redeemable preference share with the 5% premium after observing the necessary requirement of the Act. For the purpose of the redemption of the preference share, the amount of rupees 1 lakh has been transferred from General Reserve to Capital Resumption Reserve. Then fourth adjustment, the company issue a bonus share of the existing activity equity shareholders from the capital redemption reserve in the proportion of 2:1. The debenture are issued at a 5% discount. 25,000 has been paid the tax last year and the amount of the proposed dividend of the last year also paid. From the above information, prepare a cash flow statement. So we have to prepare an investment account, second land and building account, machinery account, then redeemable preference share account, then security premium account, general reserve, capital redemption reserve, then tax provision that are tax paid, and if we find if necessary account will be there, we will make it. So first we are starting from the investment are sold at a 20% profit on its sell proceed. So let's start. We are writing investment account illustration number 12. We are writing opening balance and closing balance. Opening balance 40,000 is given. To balance brought down 40,000 and closing balance is given nil. So by balance carry forward would be nil. That means all the investment 40,000 investment are sold, but information is given that is at 20% on its sales proceed, but here we are having the cost value. So we need to find out the value of the sales. So what is given? 20% profit on sales. So suppose selling price is 100, 20% profit will be there. We will get a 80% cost price, right? So 40,000 is a cost price, it is a 80%, right? So what would be the 100%? It will come 50,000. 100 into 40,000 divided by 80, it will come 50,000. That means selling price is equals to 50,000. So how much profit? 50,000 minus 40,000. Profit is equals to 10,000. Understood? So let's put the effect. So 50,000 bank account in a bracket sales of investment, and 10,000 is profit that is transferred to P&L account account. So in this transaction the cash flow is affected. It is when we are selling the investment, it is a cash inflow. So we are going to add in our investing activity sale of investment of rupees 50,000 and the 10,000 we will deduct from the profit and loss account. So less profit of sale of investment of rupees 10,000. Understood? Now this account get automatically get closed. Now second entry, depreciation written off land and building 30,000 and plant and machinery 25,000. So let's put down the opening and closing balance. Depreciation. So depreciation on land and building, it's 30,000. Same way depreciation account 25,000. Total 30,000 and 25,000. $55,000 depreciation. We are going to add depreciation 55,000. Understood? Then a company has a redeemable preference share with the 5% premium, and for that purpose they are going to transfer a 1 lakh rupees to general reserve to the capital resumption reserve. So first we are placing the opening balance and closing balance of the preference share, general reserve, capital redemption reserve, and the security premium. First we are putting the entries over there, then we will give the effect. So the 10% redeemable preference share by balance brought down of rupees 70,000. Then security premium by balance brought down 15,000, and 10,000 is a closing balance. 2 balance carry forward. Then general reserve by balance brought down 80,000, and by balance carry forward 50,000. Capital redemption reserve we are making in this adjustment. So first we are transferring a 1 lakh rupees general reserve to capital redemption reserve. So first we are transferring general reserve to capital redemption reserve. So it will come this side, credit side. We are transferring general reserve to the capital redemption reserve. So it will, in the capital redemption reserve, it will come in a credit side. So in the general reserve, it will come debit side. So by general reserve account, and here to capital redemption reserve account. Right? Now we have to redeem the preference share with the 5% premium. So first, the 10% redeemable preference share, 70,000 rupees. 70,000 rupees is there. That means it's unpaid. Still 3 rupees is unpaid. So first we have to convert the fully paid up. So we are making the call. So what would be the entry? By bank account. We are receiving the last third call of that which amount is unpaid, we are calling accepting that money from the preference shareholders. So we are receiving the money, bank account, 3 rupees is unpaid, so amount would be 30,000. So first we have to convert it the partly paid up to fully paid up, and we are receiving the bank, that means we are receiving the cash of rupees 30,000. So it will give the effect in the cash flow from the financial activity, that is 30,000. Preference share final call amount, right? Now we are going to redeem with the 5% premium. So 1 lakh 5,000, 1 lakh 5%, it will come 5,000. So here we are redeeming the 1 lakh to the preference share holders account. And ultimately we are giving the 1 lakh 5,000 rupees. So this premium account was debited into the security premium account. So it will come here 5,000 to preference shareholders account. And ultimately 1 lakh 5,000 we are paying back. So 1 lakh plus 5% premium 5,000, 1 lakh 5,000 we are paying outside. So it will minus 1 lakh 5,000 redeemable preference share. Then fourth adjustment is the company issue a bonus share to existing equity shareholders from the capital redemption reserve in the proportion of the 2:1. So using the capital redemption reserve, that is a 1 lakh, the balance is 1 lakh, we are going to give in the ratio of 2:1. So we need to calculate that. So ratio is 2:1. That means at a 2 equity share, 1 bonus share will be there. There is a total number of equity share is 20,000. So how much bonus share? The bonus share will come 10,000 shares, and then 10,000 into 10 we will get 1 lakh rupees. Right? So using that capital redemption reserve, we are going to transfer into the bonus share. So 1 lakh rupees bonus share. Right? And there is no effect of the cash just because there is a no cash transaction included in this transaction. Then next, debenture were issued at a 5% discount. Debenture issued at a 5% discount. So we need to make a debenture account. Debenture account. Opening balance is not given directly. The closing balance is given. So by balance carry forward 1 lakh rupees is given. That means 1 lakh rupees no debenture were issued, right? At a 5% discount, that means it include 100%. So 1 lakh rupees is a 100%. So what about the 5%? So 1 lakh, it will come debenture discount is equals to 5,000. Understood? That is a 5%. 5,000 is a debenture discount. When we are issuing the debenture, we receive the cash. We receive the cash. So here will come by bank account 95,000 and 5,000 is by debenture discount. Right? So 95,000 we are receiving cash, that is a cash inflow. So we will put in the financial activity 95,000 debenture issue. And 5,000 is the debenture discount. So we'll add over here, that will affect the profit. That is debenture discount 5,000. Right? Then last 25,000 has been paid a tax as the last year, and the amount of the proposed dividend of the last year is also paid. So let's find out from the provision of the taxation, that is opening balance and closing balance. By balance brought down, it is a 24,000, and to balance carry forward is equals to 30,000. That is, the 24,000 tax is paid and 30,000 is a new provision of the taxation has been made. Right? So we will give the directly effect of the 24,000 tax paid bank, and we are making a new provision by P&L account 30,000. So here will come the 30,000 provision of tax 30,000, and at the last tax paid 24,000. Sorry, that is a 25,000 tax paid. 25,000 tax paid. So it will come over here 25,000 in minus. So it will, new provision would be 31,000. Just because when we close the account, it will come new balance sheet of 31,000. Sorry. And proposed dividend of last year has been paid. That means dividend paid last year is 20,000. So we are going to pay a dividend. Proposed dividend 20,000 paid, and a new make a provision of the proposed dividend is 36,000 plus proposed dividend. Done. We almost covered all the additional information. Then we are going to start with the balance sheet. First is a redeemable preference share that we will redeem it. Then equity share capital 1 lakh new issued. So it will automatically increase 1 lakh and it will become a 3 lakh by issuing the new bonus share. That is, no cash transaction will be there. And sorry, we are left to close the accounts before the start. So let's going to close the account. 2,50,000 plus 30,000 minus 1,60,000. It is a difference of the 1,20,000. That means we have purchased to bank account purchase. When we are purchasing the account, it will come investing activity minus purchase of land and building of rupees 1,20,000. Then we are closing plant and machinery. So it will come 25,000 plus 2 lakh minus 1,40,000. It is 85,000 purchase. 85,000 to bank account purchase. Same effect overcome here. Purchase of machinery. Then we redeem the preference share, so it will automatically get closed. Now security premium, it is automatically closed. Now general reserve, so 1,50,000 minus 80,000, it will come 70,000. That means additional P&L, new general reserve is made. So by P&L account, so it will come over here plus general reserve 70,000 . Then capital reserve get automatically get closed. Provision of taxation, it is also closed. Then debenture, it is also closed. Right? So let's remaining effect from the balance sheet, we are going to continue that. Security premium, we closed it. General reserve, we closed it. P&L differences, so 75,000 minus 35,000, it is a 40,000. So net profit 40,000. Then 12% debenture, we issued it. Bank overdraft 20,000 was there, but now there is a nil, so we paid there is a nil in the bank overdraft. Then creditors increased 50,000 to 60,000, so we are going to add increase in current liability, increase in cash flow. So increase in creditors 10,000. Then provision of taxation and proposed dividend, we given the effect. Then goodwill 80,000 and 60,000, that means 20,000. So goodwill written off, so plus goodwill written off 20,000. Then land and building, plant and machinery investment, we have effect all that. Then stock 20,000 increase and decrease in a cash flow. So stock minus 20,000, increase in stock, increase in stock. Then debtors decrease, so we are going to add decrease in debtors of rupees 4,000. Then bills receivable equal amount. Then cash opening balance 10,000 and closing balance is 51,000. So we are going to add A plus B plus C, then plus opening balance 10,000, and the answer should be 51,000. So let's close the account, total the A, B and C and find it out, it's 50,000 coming or not. So total of the A is coming 2,16,000. Then total of the B is coming minus 1,55,000, and total of the C is coming need. So total of the ABC is equals to 2,16,000 minus 1,55,000. So it will going to come 61,000, and opening balance is a 10,000. So we are going to add a 10,000, and there is a bank overdraft effect. I missed out that bank overdraft effect. So we will pay the overdraft from the bank balance. So we will add less over here, bank overdraft. So we will deduct the effect of the bank overdraft paid. So minus 20,000. So it will come 51,000. Understood? Thank you.